So, welcome back. In previous lectures, we looked at fixed income securities, such as treasuries and corporate bonds. We also looked at equity instruments, stocks and preferred stocks. In this lecture, we're going to look at derivative securities. And specifically, you will learn what a derivative security is, the different kinds of derivative instruments, where they trade, why there exists a clearinghouse, and why trade derivative instruments in the first place. So what is a derivative instrument? Well, a derivative is a financial instrument whose value depends on or derives from the value of another underlying asset. That is, the value of the derivative depends on the prices of other traded assets. So for example, a stock option is a derivative whose value depends on the price of the underlying stock. But derivatives can be dependent on almost anything. Can be a commodity, could be an index, could be an interest rate, really anything from, say, price of hogs to the amount of snow falling on a certain ski resort. And I'm not kidding. So in this course, we're going to look at some different examples of derivative securities, such as options, futures, and forward contracts, and swaps. So derivatives serve as important tools for both hedging and speculation purposes, and I'll talk about that in a minute. Since the introduction of derivatives, there have been many developments in the derivatives markets. So there is now active trading in equity derivatives, as I mentioned, like stock derivatives, stock options, or stock index options. Credit derivatives, where the underlying can be a fixed income instrument or an interest rate. Commodity derivatives, where the underlying asset can be an agricultural commodity, say wheat or oranges, or a precious metal, such as gold, silver, a natural resource like oil, energy derivatives like electricity derivatives, and there exist even weather derivatives, as I mentioned. Now, derivatives can trade on organized exchanges or over the counter. On exchanges, individuals trade standardized contracts that are defined by the exchange. In contrast, over-the-counter markets, derivative instruments are customized. So you have to find another party to transact with. And therefore, the transaction costs are higher. The most important feature of exchange-traded derivatives is the existence of a clearinghouse. The clearinghouse basically guarantees the performance of the derivative contract. So whenever an investor takes a position, the clearinghouse takes the opposite position. In other words, the clearinghouse acts as the buyer if it's a sale, or as the seller if it's a purchase, so that the investor does not have to worry about the counterparty risk. Now, this is an important difference from the over-the-counter markets, because when we trade in over-the-counter markets, there is no clearinghouse, and we face counterparty risk. Derivatives have been very successful innovations in financial markets. But why trade derivatives in the first place? Well, they are essentially tools of risk management. So for example, an investor who faces risk associated with the price of an asset can use derivatives to reduce or eliminate this risk. On the other hand, derivatives are also very popular with speculators. So if you would like to bet on the future movement in the price of an asset, you can use derivatives to get extra leverage and get higher returns. Finally, derivatives are also used by arbitrageurs who spot and try to exploit price discrepancies between different assets. And so they are very instrumental in making prices efficient. So in this lecture, you learned what a derivative security is. We talked about differences between exchange-traded derivative markets and over-the-counter derivative markets. We learned about what the clearinghouse does, minimizes counterparty risk. We talked about why we would use derivative contracts for risk management, for speculation, by arbitrageurs. Now, in the next lecture, let's look at some examples of derivative instruments, and let's start with options.